Every boom and bust looks unique, until you realize the same 5 forces are always at play. After reading every major book on market cycles, here's the playbook Wall Street insiders use to spot what's coming. Most investors think markets move randomly, that bubbles appear out of nowhere and crashes are impossible to predict. But when you zoom out, the same patterns repeat again and again. The names change, the assets change, but the forces behind them don't. So in this video, we'll break down the 5 forces that drive every boom and bust, and show how understanding them can help you make better decisions as an investor. The first force behind every boom and bust is capital overbuilding. Whenever an industry becomes wildly profitable, capital rushes in. Companies expand, new entrants arrive, banks provide financing, and projects multiply. It all looks like progress, but in reality, this overbuilding is the very thing that ensures profits won't last. This is how the force of capital overbuilding works. High returns act like a magnet. Managers, convinced the good times will last forever, commit to bigger plans, larger fleets, or more production capacity. Investors are eager to fund it, because they see the same rosy numbers. For a while, it all fits on itself. Profits rise, stock prices climb, optimism spreads. But economics are unforgiving. The more capital that floods in, the more supply gets built, and eventually supply outruns demand. Margins collapse, and what started as a boom flips into a bust. We saw this force vividly in Britain's railway mania of the 1840s. Railroads were the high-tech revolution of their day. George Hudson, the railway king, promised endless dividends, and railway projects absorbed more than half of Britain's total investment capital. Construction costs exploded, and when passenger demand fell short, the entire system crashed. Many railway shares lost more than 80% of their value. The force of capital overbuilding had done its work. Here's the takeaway for us as investors. Capital overbuilding always destroys returns in the end. When you see an industry where every company is expanding at once, where IPOs flood the market and analysts cheer on bigger spending, that's not safety, it is a warning. The irony is that the best opportunities often appear after this force burns itself out. Once the bust clears, weaker players go bankrupt, supply tightens, and survivors can finally earn real profits again. So whenever you hear someone say, this industry can only grow, remember the first force of market cycles. Capital always overbuilds, but capital alone doesn't create bubbles. For that you need fuel, and that fuel is credit. The second force that drives every boom and bust is credit expansion. Booms don't just feed on optimism, they run on borrowed money. When credit is cheap and easy to get, borrowing explodes. Consumers borrow to spend, businesses borrow to expand, and investors borrow to speculate. The flood of borrowed money pushes prices higher, which convinces lenders that everything is safe, so they lend even more. It is a feedback loop. More credit creates higher prices, and higher prices justify more credit. But that's why this force is so dangerous. The same leverage that makes the boom feel unstoppable is what makes the bust so painful. Once lenders tighten or borrowers can't roll over their debts, the oxygen is gone and the fire burns out. We saw this during the US housing bubble of the 2000s. After the dot-com crash, the Federal Reserve slashed rates. Mortgages became incredibly cheap. Banks invented new lending products, subprime loans, adjustable rate mortgages, even so-called ninja loans, no income, no job, no assets. By the mid-2000s, US household debt had soared to nearly 140% of disposable income. At first, it seemed like a golden age. Home prices kept rising, builders boomed, and Wall Street packaged mortgages into securities that looked safe, because defaults were so low. Rising prices created collateral for even more borrowing, the force of credit in full swing. Then the cycle turned, defaults rose, lenders tightened, and suddenly the fuel disappeared. Housing prices fell, mortgages collapsed, banks took massive losses, and a localized housing problem became a global financial crisis. Here's the takeaway for investors. Credit always fuels the fire. Easy lending and narrow credit spreads are late cycle warnings, not green lights. When credit grows faster than incomes or cash flows, risk is being ignored. When spreads widen and lending tightens, the turn is near. So remember this second force. Credit inflates booms far beyond what fundamentals justify. And when the fuel runs out, the collapse is far more severe. And that leads to the third force, psychology, the emotional engine that drives markets to extremes. The third force that defines every market cycle is psychology. Markets don't move on logic alone, they move on emotion. Optimism builds during booms, turning into euphoria. Then fear takes over during downturns, turning into panic. Investors rarely stay rational, they swing from overconfidence to despair. That's why the force of psychology overshooting is so powerful. People don't just get optimistic, they become convinced risk no longer exists. Howard Marks put it best: the greatest source of investment risk is the belief that there is no risk at all. A perfect example is the dot-com bubble of the 1990s. The internet was clearly revolutionary, but investor psychology ran far ahead of reality. Startups with no profits, sometimes no revenue, went public at billion-dollar valuations. Pets.com, a company with no real business model, raised hundreds of millions and became a household name. Kindleberger described this stage as the mania phase, the moment when everyone feels they have to get on the train before it leaves the station. Prices rise not because of fundamentals, but because people fear missing out. When reality finally hit, the crash was brutal. The Nasdaq fell 78%, fortunes evaporated. But the technology didn't disappear, the internet kept growing. It was simply that prices had overshot and had to swing too far the other way before stabilizing. Here's the takeaway: psychology always overshoots. When everyone is euphoric, risk is highest. When everyone is terrified, opportunity is greatest. For us, that means sentiment itself can be a contrarian signal. When you hear "it is different this time," be cautious. When headlines predict disaster and prices look cheap, that's when cycles quietly reset. But when fear flips into panic, it rarely stays contained. That's where the fourth force begins: contagion. The fourth force of market cycles is contagion. Booms and busts rarely stay confined to one place. Once fear takes hold in one corner of the system, it spreads quickly through the global money flows and shared psychology. That's because modern finance is deeply interconnected. The same banks, the same funds, and investors operate across markets. When one link in the chain breaks, they sell elsewhere to raise cash, and panic multiplies. As Kindleberger observed, most major banking crises are international, involving several countries sequentially. A clear example came during the Asian financial crisis of 1997. It started in Thailand, when years of heavy borrowing and speculative construction forced the government to devalue its currency, the baht. Investors panicked, but the fear didn't stay local. Within weeks, Indonesia, Malaysia, and South Korea were also in crisis. Currencies plunged, markets collapsed, and companies that had borrowed in US dollars couldn't repay. The contagion spread so fast that by the following year, Russia defaulted on its debt, and a US hedge fund, Long-Term Capital Management, nearly collapsed, forcing a coordinated rescue by the Federal Reserve. What began as a local currency issue turned into a global financial emergency in less than a year. That's the force of contagion in motion. Here's the takeaway: no market is isolated. Financial links and shared sentiment connect the entire world. Even if you avoid the bubble that burst first, contagion can still hit your portfolio through falling risk appetite. Watch global signals, sudden currency moves, bond spreads, or liquidity stress, because they often reveal contagion spreading before stocks react. So remember, contagion always spreads. It explains why crises that start small so often end up shaking the entire world. And when that happens, only one player is left to stop the bleeding: governments and central banks. The fifth and final force is policy, the response to crisis. When markets crash, policymakers step in to stabilize the system. They cut rates, inject liquidity, and launch rescue programs. These actions are necessary. They prevent total collapse, but they also create the foundation for the next boom. That's the paradox of this force. Policy saves the present, but distorts the future. As Hyman Minsky argued, stability itself becomes destabilizing. You could see this during the COVID-19 crisis of 2020. When the global economy shut down, governments unleashed record stimulus. The US Federal Reserve cut rates to zero, printed trillions, and bought assets at an unprecedented scale. Governments sent checks directly to households and backstopped corporate loans. It worked, the collapse stopped, but soon asset prices exploded. Tech stocks doubled, crypto hit new highs, and speculative behavior returned overnight. As Peter Oppenheimer notes, this wave of intervention helped trigger a bubble in technology stocks. When inflation later surged and central banks had to tighten again, those same assets crashed. The policy that saved the economy in 2020 also planted the seeds of the 2022 downturn. Here's the takeaway. Policy always plants the seeds of the next cycle. Easy money and stimulus fuel booms, while tightening ends them. For investors, that means watching policymakers as closely as markets themselves. Cycles don't repeat just because markets move in patterns. They repeat because people do. Each generation convinces itself that this time is different, that the new technology or the new policy or the new era will break the old rules. But the same five forces are always waiting beneath the surface: capital, credit, psychology, contagion, and policy, pushing the rhythm back and forward again. Understanding these forces won't let you predict the exact top or bottom, but it does let you recognize where we are in the story. It reminds you when optimism is turning into excess and when fear has gone too far. And if you can see those shifts, even just a little earlier than the crowd, that's often all you need to protect your capital or to spot the next opportunity.